everyone, welcome back. In today's video, we will be covering a topic which every internal auditor must know, and that is what are the mandatory controls that one must test while performing any process audit. So if you have already subscribed to my channel or if you have seen some of my videos, you would have seen that I have given a lot of process overviews along with the risks inherent in those processes and the test steps or controls associated with those risks. But sometimes when you're a beginner, it can become very overwhelming and it is too much to take in and understand the entire process. And that is why in today's video, I'm going to cover those controls which are common for every process. So these are like the health checkup for a company. They always matter irrespective of which process you are auditing, be it procurement, order to cash. These controls are common and are always checked. Okay, and in this video, therefore, we will understand what are these controls, what is the risk associated, which is mitigated by these controls, whether these controls are automated, manual, or are these in the nature of ITGC controls, and what can go wrong if these controls are not performed properly or are not tested. Okay, so let's begin. So the first control goes without saying is checking the policies and procedures. So why is it important? Because these define how a process should run, who does what are the rules. And without these policies or standard operating procedures, the employees will be clueless as to what needs to be done. They will not be aware of the tasks they need to perform or the rules they need to comply with. And this can result in inconsistency across different locations. It can result in employees bypassing controls because they're simply not aware of the rules. So that is why we always as auditors check the existence of policies and procedures. We check whether these exist, whether they are updated, whether they are compliant with applicable rules and regulations, whether they are comprehensive, whether they have been disseminated to the employees, and whether they are periodically reviewed. Also, they should be edited only by authorized personnel. So the next control that is important is master data management. So master data is the backbone for every process. So in order to cash, it is the customer details, the product details, the pricing master that form a part of the master data. Similarly, in payroll, it is the employee details. In R2R, it will be the GL accounts or the chart of accounts. In procurement, it would be the vendor details. So if this data is wrong, every single transaction that uses it will also be wrong. And that is why it is so important to have correct, complete, accurate master data. Imagine if there is a payroll process and an employee's bank account is updated incorrectly. So the salary will be processed to the wrong account. Main risk associated with master data management is the risk of fraud or errors like fake vendors, duplicate employees, wrong pricing. So some of the good controls could be having a maker-checker mechanism wherein all changes to master data require an approval or a 4-eye check. For example, if I am creating the master data, someone else is reviewing it. Or if I am editing it, it is also going through approval. So always check for completeness and accuracy of master data and controls around creation and modification of master data. Next important control is segregation of duties. So this could be a manual control or an IT dependent control. What does it mean? It means that no single person should control the entire process to avoid the risk of fraud. For example, in sales, if the same person can create a sales order, approve discounts, and also post the invoice, then they can manipulate the revenue. Similarly, in procurement, if one person can create a vendor, approve the PO, as well as release the payment, then that's a fraud risk. So good controls would include maker-checker principle, okay? But that would be a manual control. And we spoke of maker-checker even in master data, but when we speak of segregation of duties, it is a broader control and it is applicable not only to master data, but also to other transactions. Any transaction, there has to be segregation of duties. Manual control can exist, especially if the scale of the organization is small. but it is not as robust because it can be bypassed. So a good control would be system enforced restrictions. For example, ERP or SAP would prevent the same person from creating a vendor as well as approving POs or releasing payments. Next control is access management. Access is not restricted, then anyone can create or modify or even view the data, which could be confidential. So the risk here is unauthorized transactions or manipulation of data. For example, if a terminated employee's ID is still active in SAP, so they still have access to login and they may approve a vendor payment. Or let's say as an auditor, you have edit access instead of just read-only access. So you can also edit records, which is a risk for the company because you can manipulate the data. Some of the good controls in terms of access management would be user access provisioning only after approval. So if I'm requesting access to SAP, then somebody else, so my manager as well as the SAP access provisioning team, would approve the access. Next, there should be timely removal of leavers access. So whenever an employee exits the organization, or if there's a change in the roles and responsibilities, if there's a transfer of the employee from one department to the other, then the access should be revoked. And that is why we have periodic access reviews, which is a separate control which is performed periodically. So next we'll speak about review and approval controls. These could be manual, these could be IT dependent, wherein the system automatically routes the transaction to the authorized person for review and approval. So why is it important? Because every process needs a checkpoint to catch errors before they move ahead. So if this control is not in place, errors will go unnoticed or unauthorized transactions get processed. So that is why it is important to have review and approval controls. So there could be manager sign off if the controls are manual in nature, or there could be workflows in system for approvals based on limits, based on designation, based on the DOA. Always check that the approvals are based on the delegation of authority that has been defined and the approvals are being done timely. There's evidence demonstrating that the review and approval has been performed. Next, we'll speak about physical and logical safeguards because these help to ensure security over assets and data. And it is important to prevent theft, misuse, or loss. For example, if the cash box is not locked, there could be a risk of theft. Or if the inventory is not safeguarded properly in the warehouse, then there could be risk of damage as well as theft. If laptops are not encrypted, then sensitive data can be leaked. So good controls would be having restricted physical access, having IT policies for password protection, encryption. Next, we will speak of reconciliations. So reconciliation simply means matching two data sources. It helps to ensure that the records are accurate. For example, you're matching your physical inventory with the inventory recorded in ERP, and that is why we do a physical stock verification or a reconciliation between the general ledger and the sub ledger. And I have a separate video explaining what this means, and it is a part of the R2R series. So if you have not watched that, and if you're not sure what is meant by GL, sub GL, recon, you can watch that. So why is reconciliation important? Because it will help to identify misstatements in accounts. It will help to detect any fraud or errors. For example, if a bank reconciliation is not done, then a duplicate payment may not even be identified. If GRIR account is not reconciled in SAP, then the goods received but not invoiced will pile up. So good controls would be reconciliations being done periodically, let's say monthly, quarterly, depending on the scale of transactions and the criticality of the transactions. And also the reconciliations should be reviewed, signed off, and any differences need to be investigated and resolved. So it is a detective control and always needs to be accompanied with corrective action. Next, we will speak briefly about exception monitoring. So This is important to detect unusual transactions or outliers. Again, it may or may not be performed by the client, because sometimes when the scale of organization is small or if the controls are not very robust, you will not see this being actively performed. But even in that case, as an auditor, you can analyze the population to identify any outliers, because these controls, exception monitoring controls, help to mitigate fraud, errors, and policy violations. For example, if the travel expenses that can be approved as per the policy are 50,000, but you notice an employee repeatedly claiming higher than that amount, or you notice multiple small claims from the same employee around the same date. So usually you could have dashboards or alerts for high value transactions or daily exception reports. So these are some of the good controls. So you can consider this also while performing your audit. Another basic control which is more applicable for the ITGC side is change management, which means that whenever any change is rolled out, there has to be a business justification, there has to be a review of those requirements, there has to be a user testing, and finally the change has to be released in the production environment. So if you are an ITGC auditor, then this is something that you will also check. Helps to ensure that whatever changes are being made are justified, are in line with the user requirements.